Crypto rebound likely as Trump tariffs may bring down inflation. Inflation break-evens head south amid the Trump trade war. The ongoing U.S. China trade war is likely to bring down inflation in the U.S. economy, key sections of the financial market indicate, offering bullish cues to risk assets, including Bitcoin, BTC. In his inaugural address on January 20th, President Donald Trump promised to tariff and tax foreign countries to enrich our citizens and then fired the first shot against China, Canada, and Mexico on February 1st. Since then, the trade tensions have escalated to such an extent that as of writing, the U.S. and China have imposed retaliatory tariffs on each other in excess of 100%. Tariffs increase the cost of imported goods, which are then passed on to the consumer and could lead to higher general price level in a consumption-driven economy like the U.S. Consequently, since the trade war broke out, markets have been worried about a tariffs-led resurgence in the U.S. inflation, with the Fed adding to those concerns through its stagflationary economic projections last month. Stagflation, representing a combination of low growth, high inflation, and joblessness, is seen as the worst outcome for riskier assets. Bitcoin, therefore, has dropped nearly 20% since early February alongside broad-based risk aversion on Wall Street that has seen investors concurrently dump stocks, bonds, and the U.S. dollar. However, market-based measures of inflation such as the break-evens suggest tariffs could be disinflationary over the long run. In other words, the Fed might be wrong in fearing stagflation and will soon have a leeway to cut rates. Inflation break-evens are derived from the yields on traditional Treasury bonds and Treasury inflation-protected securities, TIPS. The 5-year break-even inflation rate peaked above 2.6% in early February and has since dropped to 2.32%, according to data tracked by the Federal Reserve Bank of St. Louis. The 10-year break-even rate has dropped from 2.5% to 2.19%. Meanwhile, the Federal Reserve Bank of Cleveland's expected 2-year inflation has held at around 2.6%. According to observers, the impact of tariffs viewed as a one-time cost adjustment relies on the reactions of other macroeconomic variables and tends to be disinflationary in the long run. When producers pass the tariff increase onto consumers, inflation levels rise. However, if there is no corresponding increase in income, consumers are compelled to reduce their consumption. This reduction can lead to inventory buildup and ultimately contribute to a decline in the prices of goods and services. Since the days of Smoot-Hawley, tariffs have never been inflationary. Rather, they are deflationary and stimulative themselves. Moreover, the disinflation shown in these charts will help encourage the Fed to soon ease as well. The cavalry is coming. Jim Paulson, author of the Paulson Perspectives newsletter and a Wall Street veteran with 4 decades of experience, said on X. A paper published by American economist Ravi Batra in 2001 made a similar observation, saying, tariffs in the U.S. were never associated with rising prices and trade liberalization with declining prices. High tariffs were always followed by sharp drops in the cost of living. Tariffs produce inflation only in non-market or dualistic developing economies, but not in advanced economies. All things considered, the recent financial market turbulence likely resulted from growth fears rather than inflation. The bull could soon re-emerge in anticipation of a dovish stance from the Federal Reserve.